All right. All right. Thank you, everybody, for joining me again for another Investor Savvy Agent training. We're going to call this a series. Last time we talked a little bit about what it means to be investor savvy at a very high level. So if you guys missed that training, you have to go to YouTube, FYR University, or send me a message and I can send you that link. Today, we're going to talk about how to analyze rental properties without a finance degree. These are basic terms and formulas that you would or should know as an investor savvy agent for yourself, or if you're working with other investors. These are the key terms and formulas that, like, when you start speaking this lingo, investors realize, like, okay, you are legit, you know what you're talking about. You are a true investor friendly agent, versus the agents that just work with investors but just kind of paper push. I apologize to those that are those. Let's see. So, and I will also apologize because I am on the West Coast and I'm in a business center that has a coffee bar. So if you hear any noise, just ignore that. That's what that is. All right, today we're going to be learning about the key numbers that investors care about. These are just a few of them. These are the ones that you would probably hear about the most when you're first getting into investing. There's some other metrics that some investors care about, but we are covering, I'll say, the most frequently heard or used key terms and metrics. We're going to talk about, we're going to do some simple, very, high level round number, step-by-step deal analysis. We're going to have some examples on a fictional property, kind of walking through how we figure out some of these metrics so that way you can go and practice them on your own. And that's kind of where the practicing the rental with easy numbers, that's what we're going to do. We're going to do the step-by-step analysis, practice with some easy numbers, and hopefully give you something that you can take away and practice and use in growing your business or growing your own wealth by doing your own real estate investing. All right, so we have a nice group today. So I like to do these check-ins partly to get some engagement from the group. So I'm curious, I can't see everyone, but if you want to leave a comment down below or raise your hand, how many of you in this group have ever analyzed a rental property before to see if it's a viable purchase? I don't know. I don't see any hands raised. And I acknowledge now I realize I can't see the comments either. So, oh wait. Okay, Lars has. Okay. I'm curious to see what metrics you used, Lars. I may ask you to come off of mute. So Lars, when you did that analysis, did you figure out what the cash flow was on that
Yes.
property?
Yeah.
Okay. And you feel pretty confident explaining what cash flow is when you're talking to someone?
I think so. Yeah. Yeah.
Okay. All right. So for those that don't, we'll go into that a little bit further.
Okay.
And I might have mentioned this before. This is kind of an Easter egg, but does you or anyone else know what DSCR stands for? Okay. We'll talk about that too. That is a ratio that's used when it comes to certain loan products that are specific to investors. All right. I'm much calmer than I was last time. Last time I was like zooming through these. Um, all right. So these are the most common terms that you will come across when you are getting into real estate or engaging with a real estate investor. Cash flow, we just talked about before, which essentially is what cash is left at the end of the month after you pay all your expenses to include the mortgage. So this is the basic formula right here. It's what rent you can get from a property per month minus your monthly expenses and your mortgage. And then whatever's left over is the cash flow. As far as expenses go, expenses can be a little bit tricky because there's folks that just think, oh, I got to pay for lawn care or some like landlord paid utilities. But this also includes setting aside funding for maintenance or what's called capital expenditures, which is normally something investors do is they figure out, like, maybe they know they're going to need a roof in the next 5 years. They get an estimate for a roof. They divide that by, 5 years, by, 12 months within 5 years, however months that's equal to. I clearly need a calculator. And those are things that go into expenses. So expenses you really have to dig into. It also includes property management. A lot of investors run into issues when they estimate cash flow because they don't take into account all of the expenses when it comes to a property. And unfortunately, they get surprised by it when they're like, oh, I didn't think about that. And then the property doesn't cash flow quite like they thought it would. Cap rate, you'll hear about this. This you hear about more, I'll say, with investing in commercial properties or apartment buildings. It's a quick way to compare rental properties, and that's annual net income divided by purchase price. Cash on cash return is another big one that you will hear. And this tells you how much cash you make each year compared to how much of the money of your own money you spent into the property. So this essentially is like, does your cash make you a percentage that's higher? This is how I look at it, than you would get if you put it into a savings account or into some other type of investment. This is kind of what this is. This is kind of like the interest you would earn back on a prop on it on your cash if you invested it in some other tool like that. That might be a good way to look at it. DSCR, like I mentioned before, that stands for debt service coverage ratio, and that ties into a DSCR loan, which I mentioned in the last training a little bit, is a commercial loan that is based on the income that a property can generate, not on a person's credit. So these loans are given usually to entities like LLCs or incorporated entities. And so this is a way that investors, especially seasoned investors, are able to get so many loans on properties under their belts because it's not necessarily tied directly to them. And this is the ratio that most lenders will use to determine whether or not a property qualifies for a DSCR type loan. And that's the property income divided by the mortgage payments. They basically want to make sure that whatever rent you're getting can pay for the mortgage. They don't really take into account other additional expenses. Their main concern is the mortgage payment. Some other terms you'll hear a lot are ARV, that's the after repair value. That's not so much a formula, that's more of when you make modifications or improvements to a property, how much will it be worth after those things are done. So a lot of investors, if you're working with an investor, they may ask you to find them fixer uppers and then ask you what's the ARV so they can try to determine how much they want to offer on that property. Usually the formula for figuring that out is the simplified version is that they want to take what the ARV is, they want to subtract out what the renovation cost would be, and they usually add in a little bit of a buffer or profit, and they want to basically pay the different, like with the amount they would offer on that property would be the ARV minus all of those renovation expenses, minus any profit, minus a buffer, then that becomes their like max offer for that property. Um, we talked about BRRRR last time as well. That's a strategy when it comes to investing that you'll hear a lot about. It was popularized by Bigger Pockets, which if you don't know about them, you should look them up. It's a company that does a lot of real estate investing education. We'll talk a little bit more about them later. But that essentially means when that's another investing, that's a type of investing where an investor will buy a property, rehab it, rent it out, refinance it, and then repeat the strategy because they take the money from the refinance and then roll it into the next property. So it's a great way to work with limited funds to continue to roll the money over and buy properties. In this market, it's been a little bit more difficult to do what we call a perfect BRRRR, where you're able to pull out all your funds. But if you find a good deal and you're able to negotiate a good deal, you should be able to at least recover most of the funds out of that deal and then roll that into the next purchase. Appreciation, we hear a lot about this all the time. That's essentially the increase in property value over time. This is just an example of appreciation here. This goes into strategy. We'll talk a little bit more about that later too, because a lot of investors, when they're thinking about strategy, they're either deciding whether they're interested, what their main focus is on monthly cash flow, appreciation, or some combination of the two. And then return on investment, or ROI, just measures the profitability of your investment. Some of these terms are very similar, like they measure slightly different aspects of an investment, and they're very similar. And again, these are just a few of the key metrics. These are the most popular metrics you'll see. But the most important thing really is understanding what's important to you if you're the investor, or what's important to your client that is the investor, of which metrics matter the most to them. All right, so here we're going to go through a quick example. And again, I apologize for any noise you guys hear in the background. All right, So we have a simple, very simple round numbers, clearly not a property in the DMV because I don't think you can find even a condo for 100K. But we have a property that you're purchasing for $100,000. The monthly rent is $1,200. Monthly expenses are $400, and the mortgage is going to be $500. So when we're calculating the basic cash flow, this is going to be your rent minus your expenses minus your mortgage. In this particular example, would leave you with about a $300 per month cash flow, which is really good in this particular market. In a lot of cases now, people are getting 100, 150, 200, and they're just kind of like, okay, if you can get to break even in some cases, that's a great deal, depending on what your goals are. But this is the basic cash flow formula. So like I said, it's essentially the money that's left in your pocket after all expenses. This is a simple one. It's really cool. Like if you want to do some practice, is pull up some listings from the MLS, kind of do some research on rental rates, and then kind of figure out what the cash flow could be on a potential deal. So from there, we're also going to talk about cap rate and cash on cash return and how to figure those out, because those are some of the most commonly used or heard like things that you hear about in investor circles. So the first part of the cap rate is calculating your net operating income, also known as NOI, which is your rent minus your expenses. In this case, your expenses don't include your mortgage. NOI, when you're calculating your net operating income, that does not take into account mortgage. It's just expenses. So the numbers from our example show that our NOI would be $800 per month. The annual NOI is that monthly amount times 12, which would equal $9,600 per year. And then to determine the cap rate, you would take the annual NOI and divide that by the purchase price, which in this case was 100K. And that ends up with a 9.6 cap rate, which if you were a buyer, that would be a very good cap rate. And then calculating the cash on cash return is your annual cash flow divided by the initial investment. So in this case, I don't think it was in the previous example, but you're assuming you put about 20% down on that 100K property because most commercial loan products require about 20 to 25% down. So that's where the 20K comes from. And so this would give you an idea, like if I invested, I'm getting about $3,600 per year. In this particular example, I put 20K in, that gets me about an 18% cash on cash return. And I'm going to hit again my note down here. I try to make it a bumper sticker, but I couldn't figure out how to do that. So I just underlined it and put it in bold. Different investors have different goals. And this ties back to what I said earlier. Some investors are more worried about earning monthly cash flow. They want to get cash in their pockets right now because maybe they're looking towards retiring or they want to quit their day job. And so they want to replace some of that income. So some of these metrics tailor more obviously towards monthly cash flow. Other investors may love their job and they're just looking for other avenues to invest funds in, similar to the stock market, but something that maybe diversifies their risk for, the investing risk for them. So they may focus more on appreciation. So like the DMV is more of an appreciation market. In our area where I am in Northern Virginia, it is very difficult to cash flow any property unless you're able to get like a grand slam deal, inherit a property from a family member, or potentially even like get creative. I know some folks that have purchased properties and to get the cash flow, they essentially rent by the room, but that's all very specific to the area and with the person. Like they may live there, but you have to be okay with living with lots of other people. But so a lot of investors that come to our area and the DMV specifically are looking more at appreciation. They know that the properties go up in value year over year. So they're looking at basically putting funds into essentially a property that they know will increase in value by certain percentage points every year. And when they sell, they'll be able to make a profit off of that. And then some are looking for a balance of both. So my husband and I invest in Southern Virginia, and we invest down there because that's a market that's a little bit of both. It's an upcoming market that has a lot of money coming in and new businesses coming in. So when you do research in areas, if you can find a place where the cost of housing is still relatively low, then like where we are in Southern Virginia, I'll give an example. Like you can pick up a property for 150 to $200,000, and you're able to rent it out and get a little bit of cash flow on it. But because of the economic growth going on in the area, the property values have been going up. So our strategy is actually a combination of both, where we look in markets that are affordable, we can cash flow with rents, even if it's just a little bit, 150, $200 per door, sometimes a little bit less, but we're also banking on the appreciation of the value of those properties going up. So you really need to be able to talk to your investor and understand what their priorities are, because they're not always, um, you have to get to that to understand what which of these equations and which of these metrics are most important to them. Doo-doo. All right, and this is just, I love this graphic. This is just kind of these are rules of thumb. These are general numbers when it comes to these different types of metrics. It's all very, I'll say, case by case specific. So take some of these like just as a benchmark, but not as I'll say, hard and fast like rule. Like these are not the numbers that every single investor is always going to want. So positive cash flow is always good. That just means that you generate extra income every month. In a lot of investors, their goal is $100 to $300 per month. Again, this is very market specific, because in some markets, it's much harder to cash flow than in others. So you may be like, if I'm cash flowing $50 in Northern Virginia, that's a win because I know my appreciation is going to go up. Cap rate, usually cap rate above 6% is considered good. I will say cap rates are a little bit confusing to some, myself included. My husband is usually the one that does some of these cap rate metrics, because 6% if you're buying is considered a good deal. If you're selling, you want your cap rate to be a bit lower, but you want to find that happy in between, as far as cap rate goes. If you want more information on cap rates, you can reach out to me and I will get my husband to explain it better because I acknowledge cap rates are not my strong suit. Um, DSCR, the debt service coverage ratio, over 1.2 means it's a strong loan coverage. And that's, like I said, that's basically meaning that your monthly rent can cover your monthly mortgage and then some. Like if your monthly rent can exactly cover your monthly mortgage, it's 1.0, and anything above that, like 1.2, means it's really strong. Many lenders require a minimum of 1.25, but again, this is not the case for everyone. There's many lenders that want the 1.0. Some lenders actually, because they recognize that it is so hard to cash flow in markets, if they understand that the property is worth more or that there's an appreciation play, and depending on your investing record, like if you're a more seasoned investor or if you're partnering with a more seasoned investor, I've actually seen some DSCR lenders go to 0.75 where they don't even require the entire income that the property can generate. It doesn't need to cover the mortgage, but you have to talk to the lender about that. And then cash on cash return above 10%, super strong performance, measures the efficiency of your invested capital. Um, and again, cash on cash return is very dependent. Some people will look at the bond market, to see what kind of interest they could get if they put their money in bonds. And they may just be trying to beat the bond market or be like the best savings account. So this again is also very specific. So your role as an agent is to understand which metrics matter most to your investor. So that way you can basically present properties and show them the metrics that mean the most to them, or educate them on which ones may mean the most to them. Does anybody have any questions while I take a breath? Okay, I am going to leave some more time at the end if anybody does end up having any questions. Okay, and so these are some free tools that I like to use and that I share with folks, that makes it easy to do a lot of this analysis. You can do you can use the pen and paper and do a lot of these things yourself on a spreadsheet, but you really don't have to. So one app that I really like to use, my husband loves using this, is called DealCheck.io. It is free. You can get a paid subscription so you can do more deal analysis. But this is basically a tool where you plug in all the numbers and it spits out the calculations. And my husband has done his homework. We have our personal spreadsheet that we use for deal analysis. And he's actually compared the numbers from both this tool and our spreadsheet, and they match almost all of the time. So this is a pretty accurate tool so that you don't have to like do all the number crunching yourself. Another resource that has a lot of good calculators for determining a lot of these calculations is Bigger Pockets. I had talked about them before. So if you go Google search Bigger Pockets or go to biggerpockets.com, it's a huge community. They have lots of trainings and podcasts. They have forums where you can connect with other investors or agents that want to be investors, or like agents and like other want to be investors. They also have a section that has really good calculators that you can go into and do some analysis there. And then, as always, I talked about the Cash Flow Breakfast Club because this is the book, the guy that wrote it, Omni Casey, the organization that got my husband and I into real estate investing. If you go to the cashflowbreakfastclub.com or look up their website, there is a resource page where you can sign up for a free account. And it also has lots of calculators that you can use, not just for deal analysis, but also to figure out like what your goals are as a real estate investor. It's got really good spreadsheets, very for especially for beginners if you're an investor, a beginner investor. Um, and these are great tools to practice. So, like I said before, if you grab any of these tools, grab some listings off the MLS, and just keep practicing. As far as rents go, I didn't put it on here, but this is, I guess, your bonus nugget. If you're trying to figure out what rental rates are for a particular area, there is another app that's called rentcast.io, and you can look that up online. It's a free tool, and it basically pulls MLS and public data, and it can give you an average of what the rent would be in a specific area based on public information. And that's a really good way, a quick and easy tool to use to pull rental rates for a specific area. I use that sometimes even for clients that are asking about rental rates. Like I'll look in the MLS, do some research there. But sometimes I start with Rentcast and pull the rental properties that are listed there and then go do some research. That's another good tool that's not listed here. I think getting close to the end. All right. So, like I was saying before, you don't need to be a finance pro or have a finance degree to be investor savvy. A lot of these formulas are pretty straightforward. Um, and once you understand them, you almost can do them like in your brain or in the back of a napkin. The most important things that I have found in becoming an investor friendly agent, a true investor savvy agent, is to master the core terms, because when you're having these discussions with your clients, especially if they're already seasoned investors, understanding what these metrics mean probably matters more than anything else. Like if you're familiar with these terms, if you can get a general idea of what they mean, if you can actually do some of these calculations and provide them to your investor clients or do it for yourself to show that you understand the value of the property and you understand the investor strategy, that will put you head and shoulders above lots of other agents. Use simple math. I'm all about simple math. That's why the examples earlier with all around numbers. So you can make it approachable. Some more seasoned investors just want the exact numbers, and that's where you kind of get to know your clients. If you're kind of using this to get people who are new to investing in on the investing bandwagon, using the round approachable numbers makes it easier when you're working with someone that maybe is a newer investor, that they're just getting, their feet wet in real estate investing. And like I've said repeatedly, align with the strategy. Different investors have different goals. So make sure that your analysis and the metrics that you're presenting align with your clients' goals so that they can understand the full picture of the property that they're picking up and ensure that their money is working for them as much as they would like it to. Like that's the main goal for real estate investors, is getting money and making sure that their money is working for them and generating more money. So just practice so you can get clarity, so you can become confident. Because honestly, having that is way more important than whipping out a 50,000 line spreadsheet and showing someone a bunch of numbers. Investors want to know that you understand them and what's important to them and why it's important to them. So, man, this one's going to be short because I thought I was going to fill up 45 minutes and we're only at 30. So I'm going to open up the floor if anyone has any questions. Again, this is a high level. I'm trying to make these trainings for those agents that are just coming into the real estate investing world, and I don't want to overwhelm you. So I try to make these bite size and, easily to understand. But if you do have any questions, you can find me on Instagram at the handle there. If you need to email me any questions or want copies of the presentation, this one or the link for the previous presentation that we did. I'm happy to send that to you. And if you want to listen to the Agent to Investor podcast, that's a podcast that I host with a fellow agent, Nico Garcia. And we talk about all of our adventures as becoming new real estate investor savvy agents and having our own properties. And we also have a lot of guests that come on that know a lot more than we do. So it's a fantastic podcast, if I do say so myself. And our next training, it's going to be in a couple weeks after figure out the date, but I'll make sure to post about it. But we're going to talk about creative finance. And I'm going to do my best to get a lender partner to come on with me so we can talk about a lot of the different, I'll say, financing options available to real estate investors, because you can get very creative with financing when it comes to real estate investing. It goes well beyond the traditional like VA, or I mean, you can use VA loans to get creative too, but the standard residential loan, there's so many more options out there that agents don't realize when it comes to investor financing. Let's see if any, I'm gonna try to look at the chat or try to look at the chat. Where'd my chat box go? All right, let's see. What questions do you have? Oh, short and to the point. Thanks, Kyle. Oh, thanks, Lars. And thank you, Anita. So hopefully this was easy to digest. Did anybody, oh, so here's a question. Did anybody learn something today that they didn't know before? You can put it in the comments. You can unmute yourself. Is there any piece of information you learned today that you're like, I'm going to go practice that? That's cool. I would love to hear that.
Yeah, some of the terms.
That you maybe have heard in passing, but didn't actually know what they meant.
Yeah.
Yeah, so I would say keep practicing those. Does anyone else have any feedback? I know some folks are driving and busy doing other stuff, so it's tough.
Yeah, it's Anita. I do. You made it really simple to understand, and so not so scary about if you have an investor, what you don't know. So this breaking it down for 101, and it's something that I would look into finding like some of the tools that you have, mentioned here and seeing, what's available out there. So looking at rent and just to know what the rent caps are in the area.
Yes,
So
yeah. So yeah, remember that's Rentcast.io, or if you go on Google and you just type in Rentcast, it should pull up as one of the options. Fantastic tool. We use it all the time. There's a lot of tools out there that investors use that are also very helpful for agents. So I'm glad that this was helpful. And if you have questions about when you do run into an investor and maybe you want to like practice some dialogue or kind of like go through numbers, I'm happy to do that with you as well.
thank you, because someone did ask me, what's the rental rate in the area, and I was just like, let me look in the MLS. So to see the different, areas, cities, what they're renting for. So thank you.
Yeah, no problem. And the thing I like about Rentcast is that it's all over the country. So you can put in any address and then you can tweak the criteria. Like in some cases it'll pull it from public records, but like we have properties we've modified. So now I'm like, oh, this house is now a 3 bedroom, 2 bath. What does that get you in the market? And then it'll give you a list of properties in the area that match their criteria and are close to the property. So that gives you a starting point. It gives you an average rent, what they project it should rent for, but it does give you the properties it's based off of, which is awesome because then you can kind of look into those as well and kind of do a little bit more digging if you want to like fully understand and make sure that the number is accurate they're giving you for rental rates. Okay, well, we finished early. I hope you guys don't hear the noise because not only am I in a business center in a hotel that makes coffee, but there's like a bathroom across the way. So I appreciate you guys and your patience. I will let you guys go and have 30 minutes back of your day if no one has anything else. And I hope you guys stay tuned for the next one.
Thanks, Anna.
I
It
didn't
was
hear any
fantastic.